Hi folks, and welcome to another 5-Minute Friday here on Meaningful Money. Great to have you with me again. Sorry about last week, time got away from me. These things happen. I have a life, Actually, I don't have a life. So, listener and viewer Ian sent me an email asking about what he should do when he's maxed out his pensions and ISAs and premium bonds and all that sort of stuff. Banged my hand on the desk. And he wonders whether it's worth having some money in investments which are not tax wrapped, so not in ISAs and pensions or whatever, in order particularly to make use of the capital gains allowance. Now we call that, I say we, that's the financial planning profession, we call that capital gains harvesting. Actually, do we? I don't know whether we do or not, but I do. And so that's what I have decided this will be called. Capital gains harvesting, how it works and why it's worth considering. So let's put 5 minutes on the clock down here. I'm going to do this Peter McKinnon style. No idea how much that pleased me. And say a quick thank you to 7IM down here for sponsoring the show. And let's crack on. So how does capital gains harvesting work? Well, let's use an example. That's always the best way to explain this stuff. So let's say you have £100,000 invested in just a normal general investment account, a GIA. I know, that'd be nice, wouldn't it? But let's say you do, and let's assume that that grows by, let's pick a figure out of the air, 11.7%. Why? Because that will mean at the end of year one, you will have £111,700. And the gain over the year will be £11,700. Which is quite convenient because that happens to be the capital gains tax allowance in the 18-19 tax year when I'm recording this. So you've made a gain of $11,700, but you haven't really, because in order to make that gain, in order to realize it, you have to sell your investments. It's just like, buying and selling a house. You only gain money when you actually sell the house. And the same follows for ordinary investments. You have to sell them in order to realize the gain. So let's say you have that £111,700 in a fund with, say, Vanguard, and you sell it, all of it, to realize that gain, and you reinvest it straight away in another fund with, say, 7IM. You have made the gain by selling one asset and buying another. But because that gain is within your capital gains tax allowance, there's no capital gains tax to pay. Obviously, if you're in a couple and you've got a joint investment or you've got an investment each, you both get a capital gains tax allowance. But why would you consider doing that? Well, think about it. If as you go along, let's say you hold that £100,000 investment for 10 years and in that time it becomes, £200,000. Well, if at the end of that period you sell it, you've gained that entire £100,000 in that last year, because remember, you only make a gain when you realize the investment. Whereas if you have been harvesting capital gains as you go along, you are essentially making those gains each year. So if you think about it, if at the end of year one, in our previous example, you've done your transaction to realize the gain within your capital gains tax allowance, your new starting figure is now $111,700. So when you sell subsequently, you're starting from a higher figure, so your gain is lower and hence your tax bill is lower. Do that over time, and the benefits really add up. It's one of the key things that a good financial advisor will do when they're investing money for you. If yours doesn't, ask why. Of course, this is only relevant for money not held in ISAs, not held in pensions. Capital gains tax doesn't have anything to do with those two wrappers. This is only for unwrapped money. Worth mentioning, you can also harvest losses in this way if it's beneficial to do so. Why would you do that? Well, let's say you've got a big gain coming up in a year or two's time. Maybe you're going to sell a property or sell a business or something like that. Well, if you think far enough ahead and you've made a loss on some other investments, it might be worth you realizing that loss, because you can carry forward losses for up to 4 years from the end of the tax year in which you make it. So you can carry forward losses and use them to offset future gains, thereby reducing your tax bill. A couple of other things you can do with this. You can use this transaction when you're realizing money to fund ISAs. So in our previous example, you could sell the whole $111,700 to realize the gain and drop £20,000 into an ISA and then reinvest the rest back into just an ordinary general investment account. It's really important also that you understand when you're harvesting gains, you need to sell out of one asset and presumably buy into another if you're not going to actually use the money. And it's really important that you don't buy back your first asset within 30 days. Otherwise, it'll essentially cancel itself out as a transaction. while you're switching in and out of funds, it's possible that you might be out of the market for a day or two. So that's something just to be aware of. If you're taking an income or withdrawals from your investment, it could also be that you use your capital gains tax allowance to essentially draw a tax-free withdrawal from your money by just making sure you gain within the annual allowance. It's just another little planning angle that sometimes we use with our clients. And finally, it's worth being aware of any other gains you might have made in the tax year. This is generally a good exercise. We tend to do it for our clients at the end of the tax year, say February, March, when you pretty much know what your tax situation and what your gain situation is going to be for the whole year. Okay, that's capital gains harvesting, something of a niche topic, but your wish is my command, Ian. Thank you for asking the question. If you've got a question that you want me to answer here on 5 Minute Friday, just go to meaningfulmoney.tv/askpete and I'll do my best to answer it as soon as I can. Thank you so much for watching. Have a great weekend. I'll see you next time.